10-year note yields continue to press lower, nearing that threshold, that 3% threshold, a level we haven't seen in a long time. And recall, we were going up last time we went through 3%, and we haven't really looked back until now. We've had a few moments where we've tested 305. Much like today, we test 305, we bounce back higher. We aren't bouncing back higher anymore, so 10-year note yields are going to look like they're here to stay. At least this period, we have a holiday, we've got year-end coming up, we've got a questionable Fed, a lot of things that are going on in the market, but technically speaking, it looks like the market really is trying to push down to 3%. We're going to see prices rise, we see yields go down. It is a technical move. There are a lot of fundamental reasons for it. So market's going to run its course. I have a feeling we're going to get down to 3%, possibly down to 295 before all said and done. When the dust settles, it's how the market reacts at that point. Will risk off still remain the scenario? Will we see a climb back higher to 3.25? Remember, it wasn't too long ago we were talking about 3.25 and breaking higher. That seems like really a pipe dream at this point. So market right now really pressing those lows in yield. And if you look at market volatility, it remains elevated, much like equity volatility does. As we see equities kind of falling apart here in the tech sector leading the way down, it's bleeding into all areas, whether you talk about trade tensions, whether you talk about political uncertainties here over in Europe, you got Brexit, you got Italian issues going on. There's a lot happening right now in the world, and the markets right now are starting to feel that, and you're seeing it first and foremost in the equity markets where you're seeing a great deal of selling, but you're also seeing it in the treasury market because as the yields had been rising, they're no longer doing that. They're actually reversing back lower. So as we near 3%, equities continue to fall apart. It's a lot of rising risk, and we see that reflected in higher volatility. Now, what's coming up ahead? Well, I'd already mentioned this week, we have a shortened U.S. holiday, so that's always going to put everyone on their toes across the board, not just in bond land, but also in equities. Secondly, we're going to have we have a G20 coming up at the end of November. Likewise, we have the NOVE FOMC minutes, which I think will lose a little bit of their luster, given the fact that right now the Fed is questioning how it's going to react to global events as opposed to just domestic events, and how the Fed is going to handle that as they continue to tighten. Right now, Fed funds are pricing in about 3 1/8 by the end of next year, whereas, the Fed is pricing 3 1/8 by the end of next year for an effective funds rate. The market is looking at 2 3/4. So there is a bit of disparity there. And if you've got another year, you're looking at 3 5/8 as opposed to 2 3/4. So there's a lot of disparity out the curve as we look at deferred Fed funds versus where the Fed says the Fed effective is going to be. Those two need to get a little closer together in order for volatility to decline, in order for yields to reascend, and for stocks to calm down. So right now the Fed is part of that rise in volatility, albeit not the major part. We're looking at trade tensions, we're looking at political uncertainties, and we're looking at the whole Brexit mess as we hit the year end, how will that unfold on the markets? Right now, yields heading lower, and heading lower for a lot of reasons, which means we'll probably have a few more days of this before we talk about higher yields in the forecast. This is Todd Colvin coming to you from the floor of the CME Group.